When you look at a company's financial statement, it's easy to just see a bunch of numbers. But what if I told you it's actually a story? A story about sales, about products, and about some really big decisions. Today, we're going to pull back the curtain on two key chapters of that story: what a company is owed and what it actually has sitting on its shelves. So, yeah, let's get into it. Okay, so here's a question for you. What's the difference between making a sale and actually making money? Sounds like a trick question, doesn't it? But really, it gets to the absolute core of how business works. Because look, making a sale is great, but getting that cold, hard cash in your hand, that's a whole other ballgame. And that gap, well, that's where our story really kicks off.
All right, so let's meet the first character in our little drama. It hangs out on the balance sheet, and it's basically a record of every single promise a customer has made to pay up later. Now, the fancy accounting term is accounts receivable, but let's just call it what it is, a giant pile of IOUs.
So whenever a company sells something on credit, they don't get the cash right away. Instead, they get one of these, an account receivable. The formal definition is right there, but all it really means is that it's an asset. It's a promise of future money that the company has already earned. They fully expect to collect it, eventually.
But, and there's always a but, right? Here's the twist in the story. What happens when some of those IOUs just go bad? I mean, it's just a fact of life and business. Not everyone pays up. And this creates a huge problem. How in the world do you account for money you think you're going to get, but you're not totally sure? Well, you have to make a guess. An educated one, hopefully.
And this is where accountants get kind of clever. They came up with this thing called the allowance method. And what it does is pretty smart. Instead of just waiting around for a customer to officially not pay, the company gets ahead of the game. They estimate how much they think they'll lose from bad debt, and they record it as an expense right away. The whole point is to match that potential loss to the same period when the sale was actually made. Pretty neat, right?
Okay, now this is where it gets really interesting. There isn't just one way to make this guess. There are two main approaches. First, you've got the income statement approach. That's basically saying, hey, historically, about 2% of our sales never get paid. So let's just take 2% of this month's sales and call that our bad debt expense. Simple enough. But then there's the balance sheet approach. This one is a little different. It looks at that whole pile of IOUs and says, okay, which ones are really old? The older they are, the less likely we are to get paid. So it estimates the bad debt based on the age of the receivables. See? Two totally different ways to get to a number.
And this is where the rubber meets the road. Check this out. We've got the same company's data, but run through both methods. I know, it's a lot of numbers, so don't get bogged down. Just look at the final numbers at the bottom. With the income statement approach on the left, their net receivables are $88,000. But using the balance sheet approach on the right, suddenly it's $94,000. That is a $6,000 difference for the exact same company in the exact same period. The only thing that changed was the accounting assumption. Wild, right?
Okay, so you've got this big pile of IOUs, which looks great on paper. But waiting for all that cash to trickle in, man, that can be a real killer for your cash flow. What if you need money now, like right now, to make payroll this Friday or to buy that next batch of inventory? Well, it turns out there's a shortcut. It's a thing called factoring. And here's the deal. You literally sell your pile of IOUs to a third-party company called a factor. Of course, they buy it at a discount. In return, they give you a big chunk of cash right up front. Then it's their problem to go and collect all that money from your customers. It's a way to basically time travel your cash from the future into today. Let's make this real with an example. Don't stress about all the math here, just focus on the big picture. The company starts with $100,000 in receivables. They go to a factor. After the factor takes out their fees, interest, and everything else, the company walks away with about $85,000 in their pocket right now. So what was the price they paid for getting their money fast? Over $4,600. That's the trade-off, plain and simple. You get cash in hand, but you have to leave a pretty big chunk of it behind.
All right, let's switch gears and meet the second main character in our financial story. We're leaving the accountant's office and heading back to the warehouse. We're talking about inventory now, the actual physical stuff a company sells. And believe it or not, this comes with its own brain-twisting puzzle. Just think about this for a second. Let's say in January, you buy a widget for $10. By March, prices are up, so you buy another one for $12. Come June, it costs you $15. Okay, so now you sell one of those widgets. To figure out your profit, you have to know what it cost you, right? So which cost do you use? The $10 one from January, the $15 one from June, or something else? What do you do?
And look, this isn't just some random brain teaser. This is a fundamental choice that every company that sells a product has to make.
And there are two main ways they solve this puzzle, and they are based on completely opposite logic.
So let's break this down with a couple of simple analogies. First, you have FIFO. That stands for first in, first out. Think about a grocery store stocking milk. They always push the old cartons to the front so they sell first, right? That's FIFO. Then you have LIFO, last in, first out. For this one, picture a big pile of gravel at a hardware store. When someone buys some, you don't dig down to the bottom to get the oldest rocks. No way. You just scoop from the top, the last stuff that was dumped on. That's LIFO.
So, putting it a bit more formally, FIFO assumes that the cost of the first things you bought is the first cost you record when you make a sale. And LIFO? It's the total opposite. It assumes the cost of the last things you bought is the first to go out the door. And the really important thing to remember here is that this is just an accounting assumption. It has nothing to do with which physical widget actually left the warehouse.
Okay, fine. FIFO, LIFO, who cares, right? It's just some nerdy accounting thing that happens in a back room. Wrong. So wrong. This choice, this one little assumption, has a massive direct impact on two things that every single company cares about a lot: its profit and how much it pays in taxes.
And this quote right here really nails it. It says that when prices are rising, inflation, using LIFO leads to the highest cost of goods sold. And why is that? Well, think about it. You're assuming you sold your newest inventory, which during inflation is also your most expensive inventory, so your cost is higher.
This table just lays it all out, crystal clear. Just follow the LIFO column when there's inflation. Your cost of goods sold, it's the highest. So what does that do to your gross profit? It makes it the lowest. And now for the punchline. The whole reason this matters. A lower profit means a lower taxable income. And that means you pay less in taxes. It's a completely legal way for companies to lower their tax bill.
Okay, so if LIFO saves you a ton of money on taxes, why on earth would anyone use FIFO? Well, think about who else is looking at these numbers: your shareholders, your investors. And for them, you might want to report the biggest, shiniest profit possible. And that's what FIFO does. It makes you look more profitable on paper. So you see, it's not just an accounting decision, it's a strategic one. Who are you trying to make happy, the tax collector or Wall Street?
And this chart just says it all, doesn't it? When prices are rising, FIFO gives you that nice tall bar, a higher net income to brag about. LIFO gives you the shorter bar, less profit to report, sure, but also a smaller check to write to the government. It's two different methods telling two very different stories to two very different audiences.
And you can imagine, with so much riding on these inventory numbers, getting them right is absolutely crucial. And this diagram shows why. It's like a dangerous ripple effect. Just look, if you make one tiny mistake and overcount your inventory, that makes your cost of goods sold look too low, which then makes your net income look artificially high, which then inflates your equity on the balance sheet. See? One small error poisons the well for everything. It pollutes the entire financial picture.
So what's the big takeaway here? It's this. The numbers you see on a financial statement, they're not facts carved in stone. They're not some kind of absolute truth. They are the final chapter of a story that was written using a whole bunch of estimates and assumptions about who's going to pay their bills and which widget you just sold from the warehouse.
And that leaves us with one last kind of mind-bending question. If a company's profit and even the value of its assets can change just based on which accounting method they pick, how can any of us, looking from the outside, ever really know what a company is truly worth? It just goes to show you, you always have to read between the lines, because that's where the real story is.